Well, good afternoon. We're thrilled to be here, and I am super excited. You're going to meet two amazing women who have been helping people manage and grow and maximize their wealth for decades from very different perspectives. And if we're very lucky, we're going to get some really interesting back and forth between the two of them. So you have your bios, you know who we are. I'm going to give you 2 seconds on each of us, and then we're going to dive right in. So I'm Deborah Shear. I've spent my career, most of it in the private sector and healthcare. So if there's anybody out there who's interested in healthcare, please come find me during the cocktail hour. I then went and worked with the Secretary of the VA in Washington, D.C., building public-private partnerships under the Trump and Biden administration, and I'm now serving on boards. So Jill Schlesinger probably needs no introduction. You've probably seen her many, many times before as the Emmy Award and Gracie Award winning analyst on CBS, and Jill on The Money, an incredible podcast. And so we're thrilled to have her. And Dr. Victoria Vysotina, who immigrated to this country from the Ukraine, got a PhD at Emory, and then broke every glass ceiling there is to break in the world of managing money. Started at Merrill Lynch, at Morgan Stanley, and she now has her own firm. So when we were talking about this, Jill and Victoria and I, we said, what do we really want to do here? What we really want to do here is help you plan and manage your assets so that when there is an unexpected life event, you can focus on that. You can focus on your family, you can focus on your profession, you can focus on your emotions, but you won't have to worry about your assets. So that's our big picture today. Now, Jill, you have been advising women and men for many decades, but you talked about during COVID, the calls and the pleas and the emails for advice skyrocketed.
Yeah, it was remarkable, and I think all of us remember in sort of the dark days, you had this collective experience of being stuck in your house and thinking, is this really what I want to do with the rest of my life, and how will I actually break through, because this is not actually what I would like. And I had multiple conversations with people, and my podcast went from a twice-a-week interview show to an every single day conversation with one of our listeners, just talking about the things they wanted to know. And I would say that many of the people who were calling in were just seeking permission to do something different. Hey, I want to start my own company. I'm sick of working for this place. Hey, you know what? I am just burnt. I am fried. I have been a nurse for 32 years. I can't do this anymore. I need a glide path to do something else. And those conversations helped me write a second book, which I swore I would never do. It's a horrible thing to write a book. It's really great if you do it. Good luck to you. But it's exhausting. And the book is called The Great Money Reset. It's called The Great Money Reset. Change your work, change your wealth, change your life. And essentially, it was a way to give people guardrails to make big decisions in their lives without blowing up their money. And so I encourage everybody to have sort of a plan B reset that they have operational. They don't have to put it into play, but many of us have been working for large companies for a long time. You never know when you are merged, downsized, or you're just fried. So I love what I do. I love talking to women and men. Paul, thanks for being here. And I am delighted to be part of this, and I always feel less than when I have an amazing person sitting to my left who is, just from that 2-sentence bio, is inspiring. So,
Thank
so
you,
happy to be here.
So Victoria, you have spent your career helping people maximize wealth, and I'm going to tell a little story here about how I met Victoria, and maybe this will resonate with some of you, when you think about unexpected life moments in your financial life. My father passed away now 11 years ago, and I was left as the person responsible for taking care of my mother's assets and also managing college funds for all of the grandchildren. And although I had an MBA in finance, I spent no time in the investment world. I didn't know where to begin. And so I went to the places one typically goes to. I went to banks. I said, tell me what I should do. Tell me what you would do if you had responsibility for these funds. And almost every conversation, I felt like I was being slotted into some formula. You know, what's your risk tolerance? And then we'll put you, you know, X amount in category A, B, C, and D. And I said, well, how am I going to generate alpha for these grandchildren to be able to afford college if you're just putting me into a fund? So I got very discouraged. And one day somebody invited me to a conference. And there, as I listened to Victoria talk on the stage about here's how you get alpha, and here's a contrarian investment recommendation that I'm pursuing right now as I manage hundreds of millions of dollars for these large foundations. And I thought, that's what I want, but I don't have hundreds of millions of dollars. So I sent Victoria a note and I said, would you be willing to meet with me over a cup of coffee? I need to learn more about how to move in that direction from somebody like you. And she graciously agreed. And so here we are years later. Okay, so Victoria, if the 60-40 rule doesn't work anymore, and if the putting people in buckets, which was what I was told to do, doesn't work anymore, what works now? What is the path that all of us should be following who want to build wealth, maximize wealth over time?
So I would say thank you so much. Can you hear me well?
Yes.
So one thing that Jill has done is to listen to her audience and kind of understanding where they're coming from. So very boring, but very important, right? Instead of telling you the formula, you have to listen to the client. I happen to be very fortunate working with people who either sell the companies or they go through the transition, sometimes happy one, sometimes less happy one. And then before you even tell them what to do, you need to listen and understand what are their liquidity needs, what are their plans, do they want to fund their company, do they actually want to hold what they have. And you know, working right now with VC entrepreneurs who hold 99% of their wealth in their stocks because they missed the stock market, right? They're still in large need of having an advice on remaining cash, as an example. So first you have to understand where the family is, right? Let's put that aside. From there, everybody talks about the very strategic, very large asset allocation. I was at Rockefeller Foundation. I know exactly how to do the institutional framework. The reality is that it doesn't apply precisely to each individual. You have to think about it in a much more nuanced and customized way. But you can break it down to very simple model, liquid and illiquid, right? And that's where they actually, in 2022, everything broken down. For the first time, the 60-40 stopped working, right? Now, so because the fixed income went down and the equity went down. And so when you ask how our lives are affected by what we live through, so I was very fortunate to start on Wall Street in '96. So I lived through Asian crisis, Russian crisis, tech crisis, right, debt crisis, 2008 crisis. And so I realized that the best way to make money is actually protect on the downside, right? Mm-hmm. Every idea that brought to me, and that, you know, and I would never forget that, and I know you would be experiencing that as well in your life. The very first idea that people bring to you when you start investing, sounds amazing, this person is brilliant. Then you hear 30, and I'm like, 10 of those 30 are interesting. Then you hear 300, and you say only one of them is interesting. And actually, when you hear 3,000, then you realize every single story you hear, they're trying to convince you that it's going to make money. And they are trying for real to make money. Your job as the investor is to figure out what could go wrong, right? So once you start with this, not to be pessimistic, right? But we always have to look for things that could go wrong, and that's how you protect the capital.
So I just want to hop in here as the contrarian in a moment. I love 60-40. I think it works.
Good.
And
So let's have a debate
FYI,
about that.
I've been investing my whole life. I started as a commodities trader, trading gold, silver, and copper options. And I think that the biggest problem that people have when it comes to looking forward has nothing to do with investments. I think you can hire an amazing person like Victoria and you're going to be fine. You know what the problem is? You. Because you are going to get in your own way. So I think that, like, if you really want to own your financial future, you can hire an expert, you can buy index funds. But the biggest problems that occur, and I bet you would agree with this, are not things around your investments. It's because you've done something dopey, like sign something that you didn't know you were signing, or you bought an insurance policy. Oh, I thought that was great. It was my cousin, he sold it to me. And I think that the curiosity that you bring to your work, if you brought it to your personal financial life, you would find that there's actually a pathway. You can hire amazing people, you can do it yourself. But the big issue is, how are you gonna not shoot yourself in the foot? And that, to me, if you can avoid that, you're gonna be ahead of the game. It's not that hard. Like, this is not mysterious, actually. It's a very simple equation. What am I trying to do? I think half the time people don't know what they're trying to do. So if you can just get to that point, hey, you know what I wanna do? I wanna try to like accumulate some wealth, educate some kids,
Yes.
retire when I wanna retire, and like put that down on paper. Because without that, all the investing in the world is not going to help you. You're going to screw yourself simply by not having a plan.
So let's see, how many
Okay,
people,
I really
yes.
like that, but
Wait,
I'm gonna be contained, and this is
wait,
what-
can we just, I want to stop for 1 minute.
This is important
How
because
many
that-
people in the room manage their own money or money for family members? Great. How many of you have a plan? Okay,
There you go.
they're pretty good. Okay, Victoria, you get
So
the
in the
rebuttal.
curve of wealth, a lot of people are stuck at 60-40, right?
What is 60-40? I'm sorry.
Okay,
So it's
six,
a-
go on.
40%, 30-70, depends on the age. Certain percent of the
mixture of
portfolio is
bonds
fixed
and
income.
stocks.
Right, what's
certain
risky, what's not
Right.
risky.
So, and then the problem is everybody hugs the benchmark, I call it that way. So fixed income is always the same with some nuances. Equity is always the same with some nuances. It's very hard for people who are advisors to be really differentiating once they are managing that liquid book, right? But for smaller families, that's the only thing they can do. That's when they differentiate on, I trust you, I know where your kids go to school, I can help you on everything else. When you go up the curve, and I was working at Rockefeller Foundation in 2008, when you don't change the formula and you stay in the same asset classes, except 09 saved us, we went below generation neutrality. So something that David Rockefeller funded 150 years ago would have gone out of business. We would have depleted the principal because we lost too much money. So I keep overemphasizing, I think the world has changed, right? If you were on 60-40, in 2022, you would have been down 17% on your treasury holdings.
Well, that's 1 year, it's an outlier year. Come on, like, I don't think that's
This
fair.
year,
But I'm just saying that, like, we're
Yes,
not
we-
invest for 1 year or 2 years. If we
we've
look
had
at
a
the
10
last
years of a very strong directional rally, and I think we're no longer going to be there.
All right, time will
Inflation
tell.
is here to stay, right? The way our central bank and Fed behave, our curve is inverted, and people and pension plans are underfunded because they're staying in the fixed income. If you are in the retail space, you kind of stuck, you have nothing else you can do. If you're a bigger family or endowment and foundation, you have opportunity to take advantage of certain strategic, significant moves, right? Those are, except for the area where we sit today, commercial real estate is going through the significant, fundamental, critical change, right? There are gonna be a lot of zeros, and if you're on the right side of the trade, you can actually make a lot of money as a family, right? So you're right, in that spectrum, we have to admit that for humble us, we have to be in 60-40. And if you're lucky enough to have a patient capital, you have an opportunity in the current market environment to outperform significantly the traditional.
You know what? I got to tell you, I must be a big schnook because I don't think that most people actually want to outperform, but they want to reach their goals. So, I mean, I think you have to know yourself. I think that you're right. If I had $100 million, which I don't, because I probably wouldn't be here if I had $100 million, I'd be doing something else. But maybe I'd care more about it. But I don't know. I talk to people all the time, and I talk to really rich people and middle of the road people and people who don't have that much money. And when you boil it down to like the emotional wellness around your financial life, it's like I need to get where I want to go and feel in control. That's what I think is like the driving factor that I hear about. And you probably work with a lot richer people than I know, and I get that. But I feel like for so many of us, instead of thinking about the world of like outperformance and doing this, like get your plan in action, operate your plan, and enjoy your life. Like, stop. I don't know that there maybe there's a ton of people who want to just pile up their wealth for their future generations. You might be part of that.
Well, no, but I think I think you're making a good point. But I also think if we remember, just because I lived it, the prior 10 years, college tuition and college expenses were growing at a faster rate than any part of the market.
Right.
And so I was feeling this tremendous responsibility to outperform at least that, so that the gap between, you know, what the grandchildren had and what college cost didn't grow so much further, right?
like,
So yes, in that particular case, I felt a tremendous responsibility to try to find a path to outperform.
Well, I mean, I would think of that if I were like looking at that, I would say, well, yes, you're trying to outperform, but maybe the very best idea in the world would have been like, put a ton of money into a 529 plan where it's tax efficient, and I have Uncle Sam help me pay the freight for college.
Yes, for
right?
sure you have to do that, but I don't know that that gets you there.
Is that a more elegant solution than trying to beat the market?
It is more
You do both.
elegant.
You do both.
Yes.
You do both, and you're not beating the market in that liquid piece. You try to find for the people who have patience and the patient capital, and you see that endowments, foundations, pension plans, and sovereign wealth funds, and large families, you get overpaid for that time when your capital gets deployed. It's just simple. You have to get paid for everything you do. You're talented, you have to get paid your salary, your options, your equity in your business, right? The same way, if you deploy into something that is locked up for 3, 5, 10 years, you have to get overpaid for that.
Right.
Just that alone allows you to outperform the traditional market. That's just purely formula. Now, just to change it a little bit, and talk about living a life and doing something besides investment, right? I'm a PhD in mathematics, so I'm very obsessed about STEM and so on. So if you have little children, I'm on the advisory board of Museum Mathematics, right? Please go. Please go. Please get the kids to touch the map.
Where is it?
It's on 26th and 5th. Touch the map. I would tell you one little secret, right? All of us advisors in finance, we made up all the stories, 60-40, right? Correlation, covariance, convexity. We're only doing it so we can actually have a job. Because deep down, you can take the math book, right? You can figure it out. It's not that complicated, to your point, right? But if you don't have time and you wanted to go and have somebody who really obsessively thinking about it 24/7, you can work with your advisors. But remember that it is deep down not that complicated, and we sitting here have to be able to explain to you what we do, how we do it, how we're trying to protect it on the downside.
I think
So
that's
that you have fun.
but that is so spot on because, listen, I had a tiny advisory firm for 15 years, and I remember there was this like incredibly bright dude, scientist, who said to me, "I know the math behind this better than you do." I said, "I know, but you're a psycho, and you will blow yourself up every single time we go to a market top." Because I too have lived through. So my first year on Wall Street was 1987. So I lived through a market crash, and I saw gold go a limit up and limit down in 2 days. And so every time you go through that, you know, my dad was a trader, and he used to say the beautiful thing about becoming a seasoned investor, it's like becoming a seasoned piece of meat. They whack the shit out of you, and you're like, oh, that's what it feels like. And that's what happens. But that's why if you hire somebody who's smart and has the math down and can explain it to you, then you're not going to let your emotions override it. Because listen, we all know people who are very smart people who worked at Lehman Brothers up to the bitter end, and they rode their stock from 100 to 0.
Yes.
And that emotional pull is something that is crazy. It's so striking. It's fascinating to watch. It was why actually starting my career on the trading floor was amazing, because I was with these math heads who were knuckleheads, but you could see them implode right in front of you. You could literally see them have this complete emotional reaction to making or losing money. We're human beings. We have fear, we have greed. Those are your two operational feelings around money. and they can really derail you. That's why you should hire.
So, ladies and gentlemen, make a plan, ask questions, learn math, go visit the museum, and
Watch CBS.
watch CBS.
Oh, and
Go
very-
on Jill's
and very
podcast.
important, you said something very important. Be careful and know what your spending pattern is.
Oh, yeah.
Plan very carefully, right? And don't get overly excited because your friend you went to college with starting this new company that could be zero, right?
Okay,
So
now we're out
really
of
be
time.
very careful.
Okay, and the other thing to do, which I just learned at another session, was ask your financial manager how much of your money is being managed by women. And if the answer is no,
Or zero.
or zero, none or zero, ask them to make a change.